This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in raising funding for your startup? For your next fundraise, consider Tait Capital Syndicate Platform, an online portal using a special purpose vehicle. The Syndicate Platform allows for online investment and access to over 12,000 accredited investors. Log into the Tait Capital Syndicate Platform to find your next investment. To learn more, go to taitcapital.group/SPV. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Eric Tait, founder and fund manager at Vernonville Asset Management. Vernonville Asset Management is a private investment firm created to provide investors the opportunity to invest in real assets. Their focus is creating and maintaining investor wealth through alternative investment strategies. Returns are generated for their clients by directly investing in companies and development teams with a proven track record of profitable operations, along with experienced management. Eric, thank you for joining us.
Thanks, Hall. Appreciate being here.
Great. So tell us more about your background. What did you do before you started investing in early stage companies?
Well, interestingly enough, I actually came to Houston. I did a dual degree MD, MBA at Baylor College of Medicine and Rice University. So I actually came here and went through training, decided that I really didn't want to invest in the stock market, and then started looking at investing in kind of, I guess they call it alternative assets, but what I like to call them are kind of real assets. So that's really kind of my background and how I started.
Great. So what excites you right now?
Right now, kind of digital transformation. You know, COVID has accelerated a lot of what's happening. So we probably have condensed 10 years of transformation into the last probably 18 months. So anything that is taking old legacy type processes and putting them in the cloud or creating a digital way in which to do them, that has all been accelerated. And so we're very interested in kind of that digital transformation in kind of large addressable market areas.
Great. So you see a lot of startups and a lot of investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Yeah, so it's interesting. With our venture fund, we actually have a whole Angel 101 kind of webinar series that we go through. We do it in conjunction with the ION, the new kind of technology center here in Houston. And we literally go through all of that. But the number one thing I can say is management. Really dig into the management. And their ability to execute on what their plan is and their ability to be coachable by those who are more experienced than them, and so that they are willing to pivot as needed based upon kind of market conditions. And so for everything, don't fall in love with the product, fall in love with the management team and their ability to execute.
Great. And then on the other side of that table, what do you tell startups to do before they go out to raise that first round of funding?
Actually, interestingly enough, I always believe that people should have their own cheerleading fan base. And so as soon as you think you have an idea, you should start socializing that to people, putting them on an email list, giving them updates, because ultimately those people that you keep in contact with and let them know what you're doing are going to be your funding base to get you started. And so let them see your foibles, let them see the mistakes that you make, because nobody's going to invest with somebody who is perfect, because we all know that you're going to fail and we don't want you failing first with our money.
Well, great. So let's talk about the state of startup investing. How do you see the industry evolving here post-COVID?
It's interesting. Right now, there's just a lot of money sloshing around the country. So valuations are very, very rich, let's just say. So, you know, and I can go on and on about kind of Fed macroeconomic policy and the amount of currency being created and where that currency is ultimately flowing. But all assets right now, I would argue, are very rich. And so you're going to have to, as an investor, you're going to have to pick through and kind of find value where you can, because there are a lot of people chasing the same kinds of deals, and there's a lot of money chasing those deals. And so pricing is going up, even on just ideas. It feels very frothy.
Great. And so what do you think is the biggest change we'll see in, say, the next 12 months?
The next 12 months, I actually don't know if I can say what the biggest change will necessarily be. I mean, a big trend that is going is much more democratization in the venture space. It's something that we do kind of at Urban Capital Network on the venture side of our platform, is allowing investors who never had access before the ability to get into venture. So a step further or a step past the angel investing space. You're going to see a lot more of kind of the crowdfunding type platforms getting venture deals and allowing smaller investors access.
That's great. And so tell us more about your investment thesis. What exactly do you look for and what is your thesis?
Yeah, and so I actually have two different companies that I founded. So Vernonville is the one that kind of brought me in the front door here. On that, we do a lot of real estate investing, private debt, and angel investing. And to reverse that, the angel investing, I usually will have to either be an advisor for the company, or I will have a direct contact in the C-suite, or a direct referral to somebody who works for the company. You're not going to really solicit us to be an angel investor at Vernonville without me having a direct kind of understanding, a direct connection with you in some way. On the real estate side of the world, just value, right? The great thing about real estate is cash flow determines your value. And so if things become too rich, you just don't buy them. So you get the choice to say, hey, we're not going to buy this because it doesn't give us the return that we want to have from a threshold standpoint. And then on the debt side, because bonds aren't generating returns higher than the rate of inflation, there's really no point in putting money kind of in my estimation, putting money into treasuries and things of that nature, or even junk bonds at this point. And so there's an opportunity to create lending for companies that have good cash flow and be able to give investors rates of return that are higher than that of inflation. On the Urban Capital Network side and the venture side, there's just a lot of good deals flowing right now if you have the right connections. And so there's that digital transformation piece. There's a lot of aggregation happening. There's a lot of money flowing into space for companies that are already established. So SPACs have been a game changer and for venture funds and venture companies that are looking to kind of up value and get money in quickly without having to go through the IPO process. And so what you're going to see, I think, is a lot more and a lot faster growth and progression of venture portfolio companies over these next 12 months.
Great. And on the angel investing side, what type of startups are you looking for? Tech, healthcare, otherwise? And what's your specific criteria for looking at a deal or passing on it?
I'll be honest with you. I am agnostic on the angel side as it relates to on Vernonville, the angel side. Again, it's for me, we're opportunistic. So if it's interesting, we'll look at it as long as I have a direct connection to the company. On the Urban Capital Network side, we actually don't put investors into angel projects on that. But at our management level, the founders, there are three other founders with myself included, we actually invest from our proceeds and our management fees. We invest a portion of that in founders of color and women founders. And so we've been finding a lot of deals in that space because they tend to be under-resourced, but not necessarily under-ideaed. So we're able to find value there. And so on the angel side, we're agnostic about industry, but on the Urban Capital Network side, from the management side, if you're an underrepresented founder of color, woman, we will look at your projects.
Great. Can you talk about one or two angel startups that you've actually funded?
Yeah. We can go back earlier and then go forward. So one of the early ones we did was a company called Data Gumbo here in Houston. They are a blockchain technology company that started in the oil and gas space, but now is spreading out into the ESG space because they can essentially track kind of carbon usage across a portfolio. And so that one has done pretty well. We also invested in a company called Myaderm, which is a CBD company, CBD cream company. People don't realize that technically CBD, you can't ingest CBD. It's technically illegal from the FDA standpoint, but you can put it topically all you want. Now, people still put it in stuff and ingest it all the time. I'm just letting you know from the Fed standpoint, kind of where that stands. And they're in probably 8,000 stores across the country. And so they're percolating along. Hoping for an exit in the next 2 to 3 years on that one. And a couple of other companies that we have invested in is a company called Humanity here in Houston. And what they do is they connect people with resources. So let's say they went to the city of Houston and the city of Houston is looking to get from the community kind of hotspots and problems. This company has a technology that uses geolocation. They can tell you there's a problem here. You can ping the city will see it and get workers out there. Or let's say you're a nonprofit and you're like, hey, we need volunteers at this site to do this thing. You can then broadcast that out. People can see it in real time and go and participate in that in those types of events. So those are kind of three companies recently that we've looked at and invested in.
Great. Well, you see a lot of startups and investors out there. What do you think is the main challenge startups face today that you work with?
So angel startups, a lot of them is just understanding the formalities and language of the startups. Okay. And so much like I'm a physician Just like in business, there's a language that people, when they are hearing pitches, they want it to go in a particular sequence and want to hear specific things. Getting early founders to put their company and put their pitches in a sequence and to think about their companies in a sequence in the way that funders think about them, that I think is probably the biggest kind of bridgeable challenge in terms of what an entrepreneur would naturally think about versus what a funder wants to see and in the process of how they want information sent to them. So I think bridging that gap is kind of a big thing. And there are a lot of accelerators out there that are helping founders do that.
Great. And then on the investor side, what do you think is the main challenge investors face today in the startup world?
Frothy valuations. I mean, it's just going to take you a while to get your money back if you're getting at high valuations. It's hard to make money when you're paying up early, right? Because the company's got to grow into that valuation so much so that it could be a very painful process. It takes away it tilts the risk reward balance away from you, right? The reason why you're willing to take higher risk on the angel side is because you're getting at a decent valuation. The reward can be so high, but if the valuations are high to begin with, that reward you're not necessarily being compensated commensurately with the risk that you're taking at this point.
What can you do about that?
You just have to be more selective in terms of the companies that you're going to be a part of. You may have to entrench yourself at earlier stages where entrepreneurs are just onboarding and on-ramping, and then be a mentor to them. Maybe get some sweat equity in on the front end, guide them to accelerators, help them with your Rolodex, things of that nature.
Right. Well, there's a lot of different sectors and applications out there in the market today. If you had to put one or two at the top of the list as being a really good opportunity for investors, what would you list up there?
Blockchain as a service is a big one. But choosing a winner and choosing an industry in which there's going to be a winner, that's still a process that's out there, right? But the blockchain as a service will revolutionize most, as I like to say, terrestrial transactions. And so keeping your ear to the ground on companies that are actually solving real world problems with real world applicability and real world cost savings for their clients. That's a big thing. And that's a trend that we are heavily invested in and following.
Well, I remember blockchain back in the 2017 ICO white paper era, and it seemed like things have progressed quite a bit further. How would you characterize the market today for blockchain applications and investments? Are they real? Are they ready? What would you say?
Few are ready. There's still a lot of fluff and a lot of hype around there. People still slap the name blockchain onto things to sexy them up and get a better valuation. But what you have to do is look under the hood and say, okay, what transactions are actually occurring on your network? Who are they benefiting? And really, who are you disintermediating with this blockchain? Because that's really what all a blockchain is doing. Is it is really just disintermediating a process where somebody's a middleman right now who's getting paid, that's going to go away. So you really want to look at, okay, who are they cutting out in this process of doing this? Or what value are they adding by creating an immutable record that people are willing to pay for? And that's always the question I would say you ask yourself is, who's paying for this and why?
So a lot of investors are looking for that killer application that's really going to take blockchain up. Early on, it was supposed to be payments in the fintech space, but it was quite slow and kind of expensive for that. And today, people are looking at non-fungible tokens, NFTs, and they're looking at decentralized finance solutions. Where do you think the killer app is going to come from?
Money will be made in those places. I do not think it is sustainable money. I think it's hot money, in all honesty, right? The sustainable, I'll give you a perfect example. Data Gumbo saved Equinor $8 million on one drilled oil well. One well, $8 million in savings, right? That is tangible, that is real. And when oil was zero or negative, that's real money, right? It may not make as much sense when oil is $60 and $70 a barrel, but when oil is $20 a barrel, that's real money that can go back to investors, that can be used for energy transformation. So those are real applications, real world things. I'm waiting for it to come in healthcare, right? Where I can just walk in and there'll be an immutable record of who I am and what I do, and there will be no more prior authorizations. There will be no more referrals needed. There will be the physicians can get paid immediately because they know that that I'm covered. And as soon as they drop in what was done, payment is released immediately. When that happens in healthcare, you will wring out probably a couple $1 billion worth of savings there. And then we can talk about it on the real estate side as it relates to titles, title searches, all of those things, right? These are things that are all coming. It's just who's going to be the winner when it's all said and done.
I always thought supply chain was going to be the killer app because I've never talked to anybody in the supply chain industry about blockchain where they just weren't jumping up and down on top of the table saying, I want that, I want that. It just seemed like it was a really good fit for them. But many people have told me there's just not enough money there for it. What's your take on that?
Again, it depends on the industry, right? If we're talking about a commodity industry, I always step back and say, okay, who's getting paid, who's paying for this, and who's getting paid, and why will they do it, right? That's always the underlying thesis of any investment, right? And in the chemicals industry, right, that's kind of a supply chain situation. There's absolutely a case to be made for cost savings. Anytime something moves physically, who is documenting it, who is saying that it went where it was supposed to go, like all of those are man hours that are happening for that to happen. So anytime anything is moving anywhere that someone is tracking and is having to pay for it, if that's what supply chain is, then, there's a human being that doesn't need to be doing that.
Very good. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think the big thing is for people to understand that everyday average investors, those of you out there with 401ks and IRAs, and I think that this is kind of a foreign concept of investing in early stage companies. It is not. I would argue to you, and I make this point when I speak to audiences, and I just spoke to a physician group up in Charleston recently, that 50% of the world's equity is outside of the publicly traded markets. And to create a truly diversified portfolio, you can't be 90% wedded to stocks and bonds, especially in today's market with it's overvalued. It's 2 standard deviations above normal valuations, right? So every time you're putting money into that space, you are paying, just like we talked about earlier, you are overpaying for something that you're not even quite sure what's going to happen in the future. And so there are ways to construct a portfolio where you have a good balance between publicly traded assets and privately traded assets. And angel investing, I would argue, can make up 5 to 10% of that portfolio and give you good diversification, but also from a risk reward profile can give you a 3, 4, 5, 6x return on your invested capital. So I think that more people should be looking at this space and trying to become an investor in this space as well. And it's not just for wealthy people or hedge funds and things of that nature.
That's good advice. So how best for listeners to get back in touch with you? Yeah,
I mean, there's 2 different ways. I'm pretty sure the show notes will have my Vernonville information. And so just VERNONVILLE.com. You can always contact me through there or eric@vernonville.com. But also on the venture side of the world, urbancapitalnetwork.com. And so that's where we do venture investing for individual investors. It's $11,000 per unit to get in. You do have to be an accredited investor. But we democratize the process because what we do is put together funds with at least 4 to 8 venture-backed companies per fund. And basically with that small amount of money, you're able to diversify across multiple companies in one fell swoop, as opposed to just concentrating in one early stage company.
We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks, Hall. I appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.